Today, let us talk about one of the reading written by Rakesh Mohan and Partha, Indian Financial Sector, Structure, Trends and Turns. We're going to do half of the reading in this recording and the another half in the next one. So in this reading, authors they have tried to tell what reforms have been taken up in the Indian financial sector after liberalization. So that is the period on which they are thirsting upon after 1991. And also, they have given you some idea about the earlier phase as well, a very brief idea about the period from 1950 to 1991. And the main focus is on after 1991, what reforms have been taken up. What reforms have been taken up in the Indian financial sector, particularly with the banking. In the next recording, we will also talk about the other things which they have talked about apart from the banking, that is, capital market, pension funds, insurance. But today, we'll be talking about the banking sector. So let us start with the three distinct phases which they say they could be easily discernible in Indian financial sector. Phase one was the phase of elements of instability, uh, which is associated with laissez-faire. So it was, I mean, there was a free market economy as far as the banking sector is concerned in the earlier decades of independence. But it was also an underdeveloped banking. So banking is not that developed, the kind of the banking which we see right now. And there were large number of banking failures also at that time. So all that led to uh, the change in the political thinking towards the banking sector in 1970s and 80s, when then Prime Minister Indira Gandhi, she nationalized 14 private sector banks. And then in 1980, she also nationalized the other uh, six more commercial banks in 1980. So authors say that by early 1980s, the entire banking sector was more or less nationalized. There were hardly few private banks at that time. And this was a period of degree of financial repression. So how do they say it is a degree of financial repression? They were administered interest rates. So interest rates were not open to the free market. Uh, they were regulated. Hmm. Uh, there were quantitative ceilings on the credit. So this sector is going to get this much credit, that sector is going to get this much credit. So the idea is there is a lot of government regulation in the working of the banking sector. Hmm. And then came phase three. This was the phase of gradual financial deepening and liberalization. So this led to the introduction of reforms in the financial sector. So by the end of 1980s, if you see, mostly the entire banking sector was nationalized. There were hardly uh, any private bank, any private insurance company. Uh, so reforming the financial sector, it became very, very important by the end of 1980s in case if proper structural economic reforms, they have to be taken up. So these were the conditions before the reforms. Now we'll go deeper into what happens to the Indian financial sector, particularly the banking sector, after 1991. Let's have a look at that. Now, the question which is asked is what are the measures which were taken up to modernize the Indian banking industry? So, the first set of reforms in the Indian financial sector, and particularly in the banking sector, these reforms were based on Narsimham Committee. So there were two reports, one Narsimham Committee 1 and the another one was Narsimham Committee 2. Narsimham Committee 2 was a 1998 report and Narsimham Committee 1 was 1991 report. So both reports, they suggested few measures. So what were the measures which were suggested to improve the banking sector, what reforms were suggested by Narsimham Committee in the banking sector, Narsimham Committee 1. Let's have a look at that. So one thing was that Narsimham Committee said this, that why don't you reduce the statutory liquidity ratio, reduce the cash reserve ratio. It will give the banks more amount of money which they can lend to the people. And they can lend it to the agricultural sector, to the industrial sector, to the trade sector. So lowering of SLR and CRR is one of the recommendation of Narsimham Committee. And in 1991, SLR was around 38.5%, and it was reduced to 25% in 1997. Cash reserve ratio also. Cash reserve ratio was around 15% in 1991, which reduced to around 4.1% in June 2003. So the main purpose is to release the funds which were locked up within RBI earlier. That was the main purpose of this reform. Then enhance the operational freedom in the commercial banks. They should be given sort of freedom to open up new branches if they want. They should be able to upgrade the extension counters. Those were the operational freedom which was suggested. And then the another thing was the deregulation of the interest rates. Interest rates, Narsimham Committee suggested that they should be allowed to determine by the market forces. So now scheduled commercial banks, they can set the interest rates on their own. Of course, there is a certain ceiling for the maximum rate and the minimum rate which they can charge. On the domestic term deposits, the interest rates are decontrolled. So they have their own say in setting the interest rates, scheduled commercial banks. It is not that the RBI is telling that, no, you can give only this rate at for the deposits. You can charge only this rate for the loan. And this increased the competitiveness in the modern banking. So how will any bank going to incentivize a customer that wanted to deposit with us and not with the other bank? It is only through giving them a better return. So that was one thing. The another committee which came up in 1998, it was Narsimham Committee report 1998, and it also suggested few things. It suggested that there should be the strengthening of banks in India. Suggested that there should be strengthening of banks in India. I'm not covering those parts here, but what they suggested was that in the stronger banking in the context of current account convertibility. They also suggested something in terms of narrow banking, right? So narrow banking concept means that weak banks are going to be allowed to place their funds only in the short term and the risk-free assets. They can't just place their funds in the long term and a very risky asset. So they don't have that much of freedom. So you should be, the NPAs, they have to be reduced. So that's a major problem, right? Then review of banking laws. That is also one of the suggestion by Narsimham Committee. They said this, that you need to review the Indian banking industry act like RBI Act, Banking Regulation Act, State Bank of India Act, Bank Nationalization Act, all of these acts, they have to be reviewed. And they gave many other suggestions regarding the capital adequacy ratio, technology upgradation, training of staff, etc. So all of those suggestions were given by Narasimham Committee, Report 2. Then, apart from Narasimham Committee report, there were other measures also which were taken up in the Indian banking sector to modernize it. One, it was a removal of automatic monetization. So earlier what used to happen was that in case if, very simplistically speaking, in case if the government has a deficit, government issues government bonds in favor of RBI, and RBI gives that much money to the government. This led to inflation. So I think there were two agreements in somewhere in 1992, 1997, which removed this process of automatic monetization of the deficit. So removal of automatic monetization. And they dismantled the complex administered rate of interest. That is also there. They promoted, other measures were to promote the financial sector, promote the financial stability, and opening up of the banking sector to the external sector also. These were few measures which were given, which were suggested. Then the development of an efficient, stable, and the liquid money market is also suggested. Then what came was, it was realized that this is the time when the banking sector, it doesn't have to be under the clutches of the government only. There should be new private banks which should enter. There should be innovation in the banking sector. And new private banks, they were licensed in mid-90s. So it allowed, Indian government allowed new private banks to come up and compete with the public banks. So of course, when there is competition, there is always the increase in the efficiency. So that was thought of to improve the efficiency at that time. Then the other measures which were taken up were to improve the credit culture in the economy. How you have to give creditors certain rights also. I have given you debt. Now, when it is a time for you to pay me back, I should be getting some kind of assurance that I will be able to recover my debt. So, and there should be the process through which I can increase the chances of my credit recovery. For that, there were few acts which were passed. I mean, one was your Sarfasi Act. So Sarfasi Act says this, that Indian lenders, they can actually recover their dues quickly. What does the act does? It is empowering banks. It is empowering the other financial institutions that they can auction the residential and the commercial properties. Whose residential and commercial properties? Those people's residential and commercial properties who have taken loans from them. So while banks give loans to the individuals, to the firms, they ask for a certain collateral. So in case if you are not able to pay, we can auction this. So this is what Sarfasi Act does. Before Sarfasi Act, in case if the financial institutions, they have to recover their loans, they have to go through a very lengthy procedure of filing a civil suit and recover their dues, which is a very lengthy, time-consuming, and expensive process. So Sarfasi Act, it helped. Then The credit information bureaus, they have also been given legal status. Bankruptcy Act was passed in 2016. So in a way, what has happened is that the creditors' rights were enforced. The process of credit recovery has increased. That is one of the measures. And the another one is, of course, this that the information technology has also played a big role in the modernization of the banking sector. It, of course, what it does, what it did was that it promoted effective, lower cost, real time delivery of financial services. Uh, Now, uh, we can do banking without even going to banks. This is only with the help of information technology. So these are the few points which you can write, how banking sector was modernized, what reforms were taken up to modernize the banking sector, right? Now the question which is arising is that can you provide some evidence that there has been the growth in the banking sector, there is an increase in the financial health of the banks. So if you look at the aggregate deposit and credit as a percentage of GDP, so how much is the deposit as a percentage of GDP, how much is the credit given as a percentage of GDP, you will find this that there is an upward trend. So that's a good thing. That's a good sign. Uh, it means that the sector is improving. Banking sector is getting modernized. People are using banking services, and even the financial health of the banks have improved. How do we know this? We know this because the your non-performing assets, they have fallen as a percentage of the gross loans or the gross advances, uh, which came down from 15.7% in 19 which came down from 15.7% in 1996 to what, 2.4% in 2009. That's a good thing, but we will take up this point only in order to show that this is a limitation also. The other thing is that the capital to risk weighted ratio, hmm, the capital to risk weighted ratio, weighted assets ratio of the scheduled commercial bank was 12.5%, and the tier 1 leverage ratio stood at 6.5%. So the idea is these are the capital adequacy ratio, that is how much is the risk exposure of the banks, how much of the capital is invested in the risky assets. So you need to have a lower capital which is being invested in the risky assets, so that the rights of the depositors and the creditors, they could be fulfilled. Uh, so, and if you compare the Indian economy ratios, these ratios, your risk capital to risk weighted assets ratio, with the other comparable economies, you'll find that these are low enough. So these are impressive, right? So can some trends be provided as far as Indian banking sector is concerned, related to the accumulation of NPAs, financial inclusion, and the new entrants in the financial sector? So as far as accumulation of NPA is concerned, you will find this that mostly Indian banking sector is predominantly public in nature. So public sector banks, they account for around 70% of the total banking assets. But the problem is that although they account 70% of the total banking assets, their share in the total profits is just 42%. And this I'm talking about in 2015. And if you compare it with the position a decade earlier, around 2003-4, you'll find is that the profitability was around 74%. The share of the public sector banks in the profitability was 74%, and it fell to 42%. Uh, and not only that, the gross non-performing assets as a percentage of gross advances, if you look at this, then also you'll find this that these gross non-performing assets, they are falling from 15% in 1998 to 3.3% in 2009, but then again it started increasing to 5.1%. Now the question which is arising is that from where these non-performing assets are coming? From where these non-performing assets are coming? Are they coming from these small industries? Are they coming from the agricultural sector? Author says no, it is not coming from agricultural sector predominantly, or small scale sector. It is coming from the infrastructure sector, and within that also, the steel is one of the sector in which is contributing most to the non-performing assets. Infrastructure and steel. Uh, so, and they gave few reasons also. They said this, that after your global financial crisis, RBI has started giving loan. I mean, they have relaxed the norms for the lending. So, in order to pump up the lending, in order to pump up the economy, they relaxed the norms. So, what happened was that there was an increase in the loans which were given to the steel industry. But at that time only, there was the sharp fall in the prices, commodity prices. And it led to the fall in the profitability of these sectors only, which have taken up loans. So it was difficult for them to pay back these loans. So there came the problem. The other problem is that there is a pressure. There was a pressure of the government on uh, giving loans through the public-private partnership. So what these banks they started doing was they relaxed their prudential norms, they relaxed their appraisal norms, they relaxed their diligence norms, and they started giving loans. I mean, some infrastructure company has come without due diligence also, they started giving out loans. So if you do not check whether the person has the ability to pay back, and if he defaults, then the fault is yours, right? And there were also some allegations as far as the interference in the working of the bank uh, through the political interference is also there, right? So there were allegations of the governance issues with the management of the selected public sector banks and the political interference also. So all of these reasons could be cited for an increase in the non-performing assets. So one thing was that the sector is predominantly public. Not only that, the profitability in the public sector is falling, and the although the gross non-performing assets they fell from 1998 to 2009, but then again they started increasing till 2015. And authors they have given reasons that why exactly they increased. And in this time, it is basically infrastructure and steel which are the main culprits for an increase in the non-performing assets, and not the agriculture and uh, the small scale industries, right? Then what are the trends as far as financial inclusion are concerned? Well, the poorer sections of the society earlier, they were not having an access to the financial services, right? And they were not adequately represented in the organized financial system also. But what has happened is to improve the the access of financial services even to the poorer sections of the society, government has taken various steps in order to improve the financial inclusion. So what are those steps? One, there is a concept of priority sector lending. So these Indian commercial banks, they will have to lend to these priority sectors. Uh, so agriculture, small scale industries, and so on. And not only Indian banks, foreign banks which have a presence of 20 or more branches in the country, they will also have to do this priority sector lending. Yeah. And in case if they fall short of their targets, then they will have to deposit this amount with NABARD that can be used by NABARD for the betterment of the agricultural sector. Then other other steps also were taken up in order to improve the financial inclusion. One of the step was there was an introduction of Kisan credit cards. There were the introduction of there was an introduction of Pradhan Mantri Jan Dhan Yojana. So it not only opened up the bank accounts, but it also provided a debit card to them. It provided some amount of insurance coverage also to them. So all of these steps, they were towards increasing the scope of financial inclusion. Uh, Then comes the entry of the new private sector banks. So what author says is that earlier only universal banking licenses were given. So universal banking license would mean that a bank would be able to do all kinds of activities, all kinds of financial activities. But now differentiated banking licenses are also given. That is, they can, so when a differentiated banking license is given, a bank can engage in only a limited kind of a service for which it has been granted a license. So the kinds of the differentiated banking license banks could be small finance banks and the payments bank. And the idea of offering a differentiated licensing banking is to have a financial inclusion, to improve financial inclusion. Uh, So what is so these small finance banks, they are nothing like but a specialty banks. They can perform the basic banking services also, and they have to give the special services to improve or to promote the financial inclusion in the certain parts of the country which are not supported by the other banks. Uh, So, for the small businesses, for small and marginal farmers, for micro and small businesses, unorganized sector entities, for them, these small finance banks are there, for which in those areas where these big banks are not going to go. Then you have payments bank. They are also there to promote the financial inclusion. How? By offering the modest savings accounts, payments or remittances services to the migratory labor workforce, etc. So the idea is customers can deposit their savings, uh, they can get remittances, but they will not be able to borrow from them. So they will have to invest in these banks. They will have to deposit their savings. So the idea is that small finance banks can offer loans, payments banks can't offer loans. Small finance banks can also issue credit cards. Payments bank cannot issue credit cards. So both of them are to improve the financial inclusion in the country. But the idea is whether these payments banks and the small financial banks are going to give a good competition to the existing banks. Now, that is unknown. So nothing could be said right now about it. So in this recording, you've talked about, up until this part of the reading, you've talked about what were the ways of modernizing, what were the reforms which were taken to modernize the Indian banking sector. We have talked about few trends which show that the banking sector has improved, its health has improved. We've also talked about few trends which are talking about the non-performing assets, financial inclusion, and the entry of the private sector banks. In the next part of the recording, we're going to talk about the other parts of the Indian financial system apart from banking. I hope you like this video. Thank you, Beta.